guys, once again, 75 even offer here now, guys. 70 even offer. Guys, this is probably the craziest I've seen it down here ever.
Even though it was a 5-minute flash crash, it took 5 months for us to do the full investigation. The first is we had to organize. So we developed and deployed a multi-divisional cross-functional team, a big team consisting of people basically from every division at the SEC. We also coordinated with the CFTC because this was a joint investigation, and they had a multidisciplinary team on their side as well. We had to basically reconstruct and understand what happened, what's the order that events happened in, and hopefully from that we'd be able to determine why it happened.
While the SEC was assembling a multidisciplinary team, Eric Hunsader continued his own research into the market delays.
So what are we looking at here?
I wanted to show how an order that comes into an exchange, how that price gets transmitted to all the other exchanges. So I built this model and represent each exchange by one of these boxes, and the prices in each one of these exchanges shows how that exchange sees the bids and offers on all the other exchanges at any given moment. This is just for one stock. There's a lot of information that occurs in the marketplace. In fact, if you were to take the first second of trading for all equities, options, futures in the United States, and you printed it on a sheet of paper so each line was a trade or a quote, the first second of data would be a stack of paper about 6 feet high.
1 second?
Yeah, one second would be about 6 feet high. It boggles the mind. Like on that day, it was we had 7.6 billion data points. You know, a billion is a big number. So we take data from all the exchanges. We save it, archive it, so that we can replay any day exactly as it occurred whenever we want. It would look to us like nobody was finding what was going on. I said, you know what, we are in a unique position to actually probably figure this out because we can play this, you know, we can just throw everything at it and see what's unusual. And so that was the thing that sucked us in, really.
5 months after the crash, the SEC report was published, identifying the cause of the flash crash as an uncommonly large order from an investment fund for the immediate selling of 75,000 E-mini contracts with a total value of $4.1 billion. Long before this report was published, it had leaked out that the source was the Waddell & Reed Investment Fund, based in Kansas City.
So how far are we now from Wall Street?
We are 1,000 miles, and we are culturally 1,000,000 miles from Wall Street.
Bill Black, a financial regulator back in the 1990s, now works as a professor of economics and law at the University of Missouri in Kansas City.
Kansas City became important as a matter of finance because it became important as a matter of agriculture and as a matter of foodstuffs, especially meat. It was the place where you came from Texas in all those Western movies with your cattle because the railroad was here and because the mighty Missouri River was here, and that's what made commerce so easy. Railroads had all this right-of-way and nice straight lines where you could lay the very sophisticated cable that allows you to transmit enormous amounts of information very quickly and very cheaply and very reliably.
The question remains whether it was Waddell & Reed that, by using these cables to place its major selling order, caused the US stock markets to plummet.
Are we at ground zero? Is this the place that triggered the flash crash? Well, the Securities and Exchange Commission in the United States and many other people say, yes, this is where it all happened, and that it was triggered by some trades, roughly $4 billion, by Waddell & Reed in a particular index.
One of the things that I think people find hard to believe is how can any order move a market? A lot of the trading that goes on is market neutral. I'm trading with you, you're trading with me, back and forth, back and forth. Tremendous amount of volume, but neither of us hold more than a small amount at any given time. I sell a little, I buy a little. I sell a little, I buy a little. I sell a little, I buy a little. And then someone comes along and they say, I sell a little, I sell a little, I sell a little, I sell a little. So wait, so that completely changes the dynamic. Where's the buy part? The behavior of all of the market participants changes because of this very, very large trade.
Waddell and Reed says it wasn't us. And what can Waddell and Reed do? Right? The more they talk about it, all they do is create publicity. And so they haven't followed that strategy.
Yeah.
Good evening.
Hello.
My name is Josh Fischero. I'm the security guard at Waddell and Reed.
Yeah.
Waddell's they don't like to talk much. But internally, as humans are, some of them who are much closer to it are like, we can't take this anymore. And so they had seen the analysis that we had done, and they said, would you like to look at our data? And I was like, yeah, send it over. I didn't really believe it was going to come over like that, and then sure enough, it did. And then I lined them up and saw how they was executed. That was the shock for me, because then I could cut through all the talk and just see the data, because the data will always tell you what happened.
If you just look at the data, there is always room for multiple interpretations. This is not a flash crash issue. This is, you take any data set anywhere, and you can have 5 people and you'll have 7 different opinions. This definitely resulted from that large trade and the way that large trade was placed. You can't see that by looking at just the information that I think other folks have looked at.
Wrote some software that took all the trades in that period of time, and I plotted it out to see where it traded. And I looked at, and I was like, so you see the red dots here?
Yeah.
That's the Waddell and Reed. These are where Waddell and Reed traded here. So all the blue dots are where they did not. You don't even see them on that one. They're not even there.
So then it's not there.
There's one little dot here, and there's one here and one here. Again, only when the market's going up. They only sell when the market goes up. They don't follow it or chase it down. So this algorithm actually is very sophisticated. It's extremely sophisticated. I mean, it would never sell at the bid price, for example. It would only sell when somebody was willing to pay that price, buy it. Just a couple here, they're selling it on the way up, and then it stops here, nothing.
In this case, what we were seeing is that the patterns were such that things were happening at the second and the 1 minute level. So we were able to take a lot of the quotes that were happening within a millisecond and aggregate them. So the data that you actually see in the report tends to be chunked up into 1 minute blocks. So you can look at it at the millisecond level, but the noise that you get in that millisecond time frame doesn't tell you much.
This is on a 100 millisecond basis. Because if you go out to a second, for example, then this will be averaged over the whole second, so it'll dilute it about 10 to 1. And if you looked at it at a minute, well, forget it. You would never see this, so it just wouldn't show up.
But does that mean to you that the SEC report is nonsense in that sense?
Well, here's what they missed. Okay, so this is when it came out. This is when we kind of had an epiphany. It says that the algorithm sold to buyers, and some of those buyers were, and I don't want to get myself in trouble with a whole group of people, so let's just say buyers. One group of buyers would accumulate up to about 3,000 contracts, and when they got that limit, then they would turn around and they would sell that position. And what the report doesn't mention is when they sold it, they didn't sell it like the Waddell and Reed algorithm did, which would wait. They sold it as fast and as furious as possible. This boom down. This is instantaneous. This is like in 50 to 100 milliseconds. They sold about 125 to 150 million worth of these contracts. Having here and having here, and then here and here and here, and then boom. And so my question is, if you're going to name Waddell and Reed, or not name them, but name them, why aren't you going to talk about this? I mean, to me, those are Those are very disruptive. In fact, they're so disruptive, that is what caused it. So this thing started, that's exactly when the market delays happened, and they just snowballed from there.
So it's one firm?
I don't know. I don't know. They would know. You know,
Who would know?
The SEC.
They would know because for them the data are
They have, okay, so all I get is time, price, a sequence number, and size. They get that, plus they get who did it.
There are some very strict disclosure rules about what can be disclosed and what cannot be disclosed. And we are subject to all of those disclosure rules, both at the SEC and the CFTC.
So you're not allowed to mention the names during the flash crash?
The level of detail that we were able to go into was the level of detail we were legally allowed to go into.
Or they want to protect somebody?
I don't know. I mean, I've done all I can do.